Google reports earnings after the bell on Tuesday, July 26th as we kick off another earnings season. In this video, we're going to talk about what we could potentially expect from Google from three different perspectives. First, we're going to talk about Google's current valuation. Then we're going to discuss the expected move and how it stacks up against the current chart. And then lastly, we're going to talk about current market conditions in Google's industry to come up with a potential trade idea for Google earnings. So let's get into it. Welcome back to Hourglass Trader, where as time passes, we make money. So yesterday we actually released a quick video about GameStop where we discussed different valuation techniques, and if you're unfamiliar with any of these that we're about to discuss, that might be a good video to go check out to understand what we're doing here. But at the very core of what we're trying to figure out here is if Google's valuation is fair. And one of the best ways to do that, as previously discussed, is the price to earnings ratio. So you take Google's current stock price, you have their earnings right here, which again we could find from their annual financials, which are available on SEC's website. We can see right here that their net income in 2021 was $76,000, which is presented in millions, meaning it's $76 billion for the most recent period. So we've got that pulled in there. And then if you search Google's stock, you can see right here that their market cap is $1.43 trillion. So with those inputs here, we know that they have an 18.81 PE ratio. And PE ratio is always good to keep in context of what it looks like in the overall market. So here we have the PE ratio history of the S&P 500 since 1880, a period I'm sure tons of you remember trading during. But point being is currently the PE of the S&P 500 sits at about 20.02. The mean PE ratio is 15.97 historically, but with that 20.02 PE ratio, a 18.81 PE ratio would actually suggest that Google's slightly undervalued as compared to the rest of the market. And during 2022, we've seen a lot of these tech companies get their multiples crushed, and this is just a great example of one of those stocks. So 18.81 suggests that Google, as it currently stands, is a decent investment. So since we're option sellers, let's quickly take a look at Google's option chain. And if we go to the trade tab in Thinkorswim, we're going to see it right here. Here are the July 29th, the weekly expiry puts. So we would potentially look at selling cash secured puts since that is a bullish position. Right at the money would be 108.36, which is what it closed at on Friday. And we like to target a 1% weekly ROR when we enter into these earnings cash secured puts. We can get that at the 100 strike. And one helpful exercise is to say, okay, you know, if we were to sell the cash secured put at a 100 strike, that means we would take ownership of Google at $100 a share. So if we plug this in here, I've actually added a calculation to say, okay, if we took Google on at $100 a share, this is what that PE ratio would be, assuming the same earnings. And just as a side note, Google has steadily increased earnings period over period over period. So having flat earnings is a relatively conservative assumption here, but as you can see, if we plug in 100 as the stock price, 17.36 is the hypothetical PE ratio that we would arrive at. And again, that's still below the current PE ratio in the S&P 500, so decent valuation at that 100 level. So from a valuation perspective, when we look at the price earnings valuation of Google, I'm relatively comfortable with where it currently sits. So the next thing that we're going to want to look at from an earnings perspective is called the expected move. And a really easy way to calculate the expected move based on option prices is to take the right at the money call and the right at the money put, which would be about 108.25, add those together and you get roughly 765, which Thinkorswim calculates for us up here. There's also another expected move concept called the market maker move, which is presented up here, and that is $6.83. So these are going to relatively be similar numbers. The 765 expected move versus the 6.83 market maker move. The only difference here is that Thinkorswim presents this market maker move number as this proprietary formula that they use to calculate the expected move, which is a little bit more in line with what some market makers are using, and in theory should be a little bit more accurate. So we're going to use the 6.83 for our calculations of expected move. So we're going to calculate the expected range. And if we type in, I forgot the number really quickly, 6.83 into our expected move cell right here, what we're going to see is that the expected range for Google is 101.53 to 115.19. And now if you're taking the perspective of an option seller, you're going to want to sell strikes either below 101.53 or above 115.19. And even if you are an investor, this concept of an expected move tends to play out very, very accurately. So it's definitely a good thing to keep an eye on if you're either investing for the long term or trying to put together some sort of a swing trade. But now the next step that we have this range is to go plot this on the Google 180-day chart, which we will pull up right here. before you throw these lines on, you want to take a quick look at the chart and the technical indicators. So on a 180-day basis, the high of Google has been $153 a share, while the low has been $102.21. If you can get a strike that lines up with that, either of those numbers, either, bullishly from 102 or bearishly from 153, I tend to think that's a pretty decent trade. Now, if we go down to RSI, it's sitting at 33.24, suggesting that Google is decently oversold right now. And why is that? We see a big red candle recently as a sympathy move with Snapchat, but we'll talk about that in the third phase of our earnings analysis, where we talk about the current market conditions. But from purely a technical standpoint, let's pop back to the spreadsheet really quickly. We see that the low end of the range is $101.53. So we're going to throw that in right about here. And the high end of the range is going to be $115.19. So $115.19. And what you'll notice here, we can zoom in a little bit because these lines are far below where it traded, at the beginning of 2022. What we like to see when we draw these lines for an expected move is that they line up with the peaks and the troughs of the chart. From a peak perspective, it really doesn't line up too nicely. It does line up a little bit with what was going on at the beginning of last week. But from a longer term perspective, it looks a lot more like that resistance point is sitting at about 120. So that's really more of an area where I would be comfortable selling some bearish calls. Now, from a bullish perspective, from a cash secured put perspective, this looks very, very nice, right? We already see from an RSI perspective that it's sitting at 33, so Google is apparently a little bit oversold right now. We see that the 102.21 level is the 180-day low on the stock, and we see our low end of the expected range lines up very, very nicely with that level. So that would suggest, just from a technical perspective, that a bullish trade right around this low 100 level would work very nicely. And again, we've got the option chain pulled up here. We could get 1% ROR right at about $100 or $101 strike. And again, remembering that price earnings valuation, taking assignment of Google, the stock at $100 a share still gives you a very realistic PE ratio. So far, all indicators seem relatively bullish. So let's move to the third phase of this quick earnings analysis, which is going to be analysis of the overall market conditions. So as we just mentioned a minute ago, you see this big red candle on Google right here, right at the end of last week. Why is that? And it's because it was a sympathy move with Snapchat, which we could pull up here really quickly, where you see a massive, massive move. And if we just pull up the 5-day chart here, you'll get an idea of just how big this candle was. It closed at 996 on Friday, which ended up being a negative 39.08% move. And if we look at the expected move right here on Google, it's 6.3%. So that, outpaces that pretty significantly. But again, Google is a much more stable stock than Snapchat, so that kind of an expected move isn't surprising. But let's also get another idea of why this dropped so much. And the biggest issue right now is there are a lot of fears about a pending recession. A lot of companies are cutting back on costs. We've seen a lot of different headlines about that. And one of the first things to go in that type of an economic environment is ad spend. And that's pretty much exclusively where Snapchat derives their revenue. And one really cool feature of Thinkorswim is if you're looking at the trade tab, you can click over on company profile for certain companies. Now, when we click on that, it's going to open it up on my other monitor, of course, but I could drag that back onto the main screen. And we actually get a really good idea of what makes up the value of Snapchat. And as you can see, it's almost entirely advertising, right? 63.4% is North America advertising, 28.7% is international advertising. That's almost all of the value of the stock. So when ad money is flowing out of the market, that's going to hit Snapchat much, much harder than other stocks because they derive their entire value from advertising. So let's run the same exercise really quickly, going back to Google. And we're going to click on that company profile button again. It once again has thrown it onto my other monitor, but we'll drag it right back. And what is a little bit concerning here is, yes, Google does have their hands in different areas, but still 72.4% of their total value is from advertising. So if this trend of companies lowering ad spend continues, that's significantly going to impact Google, which suggests to me if we wanted to make a bullish trade, there are some very, very difficult economic headwinds that are potentially affecting a large portion of Google's value. So with that said, I think that's enough evidence for us not to want to go bullish. We do remember that Google does have a good valuation, so it's one of those stocks where I think if they have a poor earnings report, the stock jumps down 10%, then I think it might be a great idea to jump in at like a 95-ish strike, because we know that if we take assignment at the mid 90 or low 90s level, you're starting to get a very, very favorable PE ratio off that hypothetical assignment price. So I think from a bullish perspective, I'd want to hold off for these earnings, but with those economic headwinds, do we potentially want to go bearish? And to me, this is kind of 50-50. We look back at that Google chart, we see that this lined up nicely with the short-term chart, but if we back it out to the 20-day, a little more pronounced resistance at that 120 level. So let's go through the exercise. Let's switch this to vertical and take a look at credit spreads with the 120 strike short leg. And there are tons of fractional strikes here, so it takes forever to scroll through, but here we go. We've got a short leg at 120, and I like to make these a little bit wider. The reason being is, look, if you have one that's $1 wide, you'll need to sell 10 contracts to make $100 on this. But if you sell one that's, $5 wide, if we can find the 125 strike here, that's $32 per spread, so you'd only need to sell 3 of them, which saves you a little bit of money on commission. So if we put this in here and hypothetically put this order through, take a look at what it looks like. It really doesn't look very good at all. It's $100 of profit for a potential $1,400 max loss. That's really not that great of a risk to reward ratio. And we are doing this after the market is closed, so the bid-ask spread might be a little bit off here. To kind of confirm that suspicion, we could look at the 120 strikes and see that they're going for about 50 cents, 125 going for about 20 cents. So that does equal a spread of 30 cents. So that calculation is correct, meaning that I don't think the call spreads offer a good return, but equally with the economic headwinds that we just discussed, I'm not convinced that a bullish position on Google is a great idea. Now, if you did choose to take on a bullish position at this low 100 strike, I think the numbers add up very nicely. You could still get that 1% ROR that we'd like to target right at that lower end of the expected move, right below the 180-day low. However, we have seen just how crazy some moves in this market can get. Snapchat dropped 40%, and while Google isn't entirely advertising the way that Snapchat is, we have seen from the company profile that we pulled up a little bit earlier that a very significant percent of their total value is made up of advertising. So that's very, very concerning. So I think the game plan here is to stay away from an initial position. And instead, if Google does drop, we have the confidence, one, knowing that it's at a very nice PE ratio, and two, that a volatile earnings event would be behind us. And we could slide in at like a mid to low 90s strike. So until then, I hate to have these analysis videos end in me not necessarily deciding on a position, but with all the factors that we take into account right here, I'm not sure that it's a great idea as of right now from an option selling perspective. I do think Google is a great long-term investment, and it's never a great idea to try to time the market. But again, I think our plan here will be just to wait and see how earnings plays out. If they're red after earnings, then we slide in. If you made it to the end of this analysis video, thanks for watching. We're trying to throw together a few more of these to kind of walk through the processes that we use to come up with our investing ideas. If you're not subscribed to our YouTube channel already, feel free to hit that button below, like the video, leave us a comment letting us know you watched the video. Follow us on everything we got up here, hourglass-trader.com. But until next time, this has been the Hourglass Trader, where as time passes, we make money.